All right, today was a pretty big, important data day. We got Microsoft earnings. This is the second of the big kahuna tech companies to report. And they're going to talk about the guidance on the call. And that's what I'm most curious about. What is their forecast for this quarter, in which they have laid off 10,000 employees, and the rest of the year? We heard Satya Nadella say earlier this year that he expects a rough 2 years for the tech industry. So I'm excited to hear the nuance of that on the call in a couple hours, or I guess in an hour. So today's video is going to be kind of short because we only have so much information. We only have the backward looking information, but you know, the Fed haters are always talking about how the Fed is using old information. So I don't know why the stock's up so much, because I don't even think the backward information is that good, and we don't have the forward guidance yet. There was one line on the earnings report that said the forward guidance would come in the conference call. So we'll see what that looks like. You know, these beats that they're talking about being beats are like they're hairline beats. They're just really not that important. Anyways, I'm just going to run through some of the numbers that stood out to me, and we'll talk about interpreting these numbers with the current stock price at the end of the video once we finish. It's just a couple numbers. Just give me 30 seconds. All right. Revenue was $52.7 billion, an increase of 2%. Fed's looking for 2% inflation. Not such a impressive number, in my opinion. Especially for a company that was supposed to be a growth company. That's not really that much growth. But operating income was $20.4 billion in GAAP, generally accepted accounting principles, and $21.6 billion in non-GAAP, and decreased 8% and 3% respectively. Net income was $16.4 billion GAAP and $17.4 billion non-GAAP, and decreased 12 and 7% respectively. Diluted earnings per share was $2.20 GAAP and $2.32 non-GAAP, and decreased 11 and 6% respectively. So a slight increase year on year on the revenue, and the income were declines year on year. Now the next one I find particularly interesting because we have a short Apple position. Again, this is not a short on the product. I'm not saying I hate Apple. They're going to zero. None of that. I just think the stock is expensive. Like, I think other stocks are expensive, but I think some of these numbers highlight why Apple might be a little bit more in the head of the storm. So, according to Microsoft, these are their numbers, Microsoft's numbers. Revenue in more personal computing was $14.2 billion and decreased 19%, down 16% in constant currency, with the following business highlights. Windows OEM revenue decreased 39%. Windows commercial products and cloud services revenue decreased 3%, up 3% in constant currency. Xbox content and services revenue decreased 12%, down 8% in constant currency. Search and news advertising revenue, excluding traffic acquisition costs. I mean, what? What good does that do? Excluding traffic acquisition costs, but whatever. Increased 10%, up 15% in constant currency. It would be really nice to know what those traffic acquisition costs look like, because that's an important part of the equation. But maybe they're saying the past doesn't matter. But I mean, advertising costs were down, I thought. Why are we excluding the traffic acquisition costs? Interesting. Devices revenue decreased 39%, down 34% in constant currency. Those are big declines in some categories. And it happens to be categories that align with Apple. So we'll see what happens. Now, let's talk about Microsoft. Let's not worry about Apple till we get more information there. I mean, we can have our predictions adjust going into that number with our predictions, but we have Microsoft information. Let's talk a little bit more about Microsoft before we get on that call. 27 times earnings. That's a very high multiple. That's well above the S&P 500 multiple. almost double. Almost, not quite, but almost double the S&P 500 average multiple. This company was once considered a growth company. It might even, some might still argue that it is considered a growth company. But after reading all those numbers, are they really growing? I mean, that's not growth. You know, every company should be growing a little bit. We called them growth companies because they were able to put up 20% annual growth year after year after year. But there's a whole lot of decreases that I just read through. Whole lot of decreases. So maybe we should adjust the multiple. Maybe we should realize that a lot of these businesses that were expected to grow 20% in perpetuity had a period where they could grow 20% in perpetuity. But when you're doing the pricing of the stock, you can't assume that growth rate forever. You should assume that growth rate trails off. And in this period with higher interest rates, slowing economy, falling birth rates, I think it's a good decision to be more conservative in our estimates of longer term growth rates. So, what does that mean? That means I think that there's earnings or multiple compression that should occur. Okay, we have to adjust to the reality that these companies aren't going to be growing 20% this year, aren't going to be growing 20% forever. And that's why we're only seeing the stock market down just a little bit. It's honestly crazy at this point how we're just not that far from new all-time highs, because it's just crazy. We're not pricing in the pricing of stocks is incorrect based on the actual growth rates of the stocks. That's just the way it is. They're not growing like they used to. And that's a paradigm shift that needs to occur. There's plenty of remnants of the past. We talked about PBF the other day, remnants of the COVID crash in that stock. There's also remnants in pricing of 20% growth rates, remnants in pricing of there is no alternative when it comes to low yields, because yields weren't offering a good return. You had to buy something like Microsoft to be safe and actually get a return. So there's remnants here, and I don't think they're going to be corrected tomorrow. Obviously, that would be great because we got some shorts on, but we think over the next couple weeks and months, that will begin to continue to play out as it has been for the last year. We've obviously seen a run here since October. It's been quite a run. It's been going on for a while. This is not, since the start of the year. It's been going on for a while. And possibly with oil prices being sticky again, who knows what's going to happen. But it's an interesting situation. So let's see what that Microsoft forward guidance looks like. That's going to be our next piece of information. That could move things or could not move things. We'll see what happens. But that's today's video. And until next time, peace out.